In the forward market, growers can again choose between swaps or multi-grade contracts to capture the price and manage risk to harvest. When a grower uses a swap for forward pricing, they are simply managing futures and currency, but not basis. When you use a multi-grade contract, you are locking in all three. Historically, basis levels in the forward market have been very weak. There's a lot of numbers there, but effectively it's the three across the bottom which are of interest. On average, swaps have outperformed multi-grade contracts by $31 per tonne per annum, indicating, and the only difference between a multi-grade forward contract and a swap is basis. So this indicates that basis levels in the forward market have been running around about on average $30 lower than basis levels at harvest. However, there has been a slight change since deregulation, and in the 4 years since deregulation, the gap between swaps and multi-grade contracts has closed up to $19.80. So in other words, the average penalty from using a multi-grade contract has gone from $30 down to closer to $20 a tonne. So in fact, there has actually been a measurable lift in basis levels in the forward market since deregulation. No longer do we just have AWB setting a price that everyone else followed, but we do actually have true competition in the forward market, delivering slightly better results for growers. Some growers might be tempted to remain using multi-grade contracts or shift from swaps back to multi-grade contracts because they are a little more comfortable with the concept. But the problem with that is the basis risk that they expose them to in drought years. Since 2000, we've had 4 years where growers have been confronted with the messy task of needing to wash out contracts, or if they haven't had to wash out contracts, have missed out on the lift-in basis that's been associated with domestic pricing or shipping pressure associated with droughts and, in 2010, the wet harvest. In each of those cases, the washout costs associated with washing out multi-grade contracts have exceeded the costs of washing out swaps by close to $60 per tonne. Just simply choosing the correct tool greatly reduces the risk of operating in the forward market. So in terms of risk management in forward selling, using swaps is actually a risk management tool in that it is very effective in avoiding the washout costs when it goes to jelly. So let's look at the post-harvest pricing. Many growers have moved to marketing their grain post-harvest. You only need to see that with the amount of grain which is now warehoused at delivery or is being stored on farm. And yet that is where the biggest changes to the market have occurred in the deregulated market. Cash prices in Australia are now driven by global wheat prices and basis levels, which are determined by exporter demand for our grain versus available supply, and basis levels are also determined by where our wheat is moving to in global markets and, in fact, whether the Russians and Ukrainians are operating in the market at any point in time as well. Under a regulated market, post-harvest cash prices were determined largely by AWB pool returns during harvest. At harvest time, domestic end users and traders had to outbid the prevailing pool to capture grain. They had to capture a good percentage of the annual requirements at harvest because there were never any guarantees that they would be able to access AWB stocks during the year. What they didn't acquire, they relied on growers to hold back to be able to fulfil their annual requirements. So effectively, that locked in the price base for wheat during the year. For traders selling to domestic end users, for example, the mid-year price really needed to be the harvest price plus carry. Prices rarely fell significantly and only rose if AWB reflected higher prices via their pools or daily cash prices themselves. That is no longer the way the domestic market or the market in Australia is structured. Growers now store more wheat, so the domestic end users and traders know that they do not have to take a position in the market at harvest time. Domestic users now buy their wheat as they need it during the year. They simply have to pay the world price of wheat as reflected by the exporters buying wheat for shipment during the year. There are two implications. Cash pricing no longer needs to be as aggressive during harvest, and the post-harvest market no longer needs to reward growers or traders for holding wheat. The natural put option that existed in the post-harvest market has now been removed. Since deregulation, farmers have become fully exposed to the international market post-harvest. That is very different to what they had become used to under a regulated market. A lot of on-farm storage was built on the assumption that you always got more for your wheat in the middle of the year than you did at harvest time, but that was built on a different pricing structure. So we line up with international price movements now that often build in risk premiums in January to March ahead of the Northern Hemisphere growing season, and then slump under harvest pressure mid-year. This slide is showing you that prior to the deregulation, which started to come into our market in 2007, January-March had never been the best time to sell wheat. Since deregulation, in 3 years out of 4, it has become a good time, or the best time, to sell wheat. So there's been a major shift in that the structure of the market in the post-harvest market. So where do pools land in all of this? Under regulation, pools performed well. Final returns exceeded harvest cash prices in all years except drought years. Pool returns did vary from early harvest estimates, but about 50% of any price move in international markets was the extent of the change in the pool return. If you looked at where the market went from November to May, the AWB pool used to go up or down by about half of that move. It is now becoming more difficult to see where pools sit in terms of maximising returns to growers, or in fact in managing price risks. The first full year of deregulation, 2008, saw pools underperform relative to the early post-harvest cash market. Off the top of my head, I think it was around about $20 a tonne. The second year was much better, as long as you chose the right pool operator, with the best pool matching average prices from that early post-harvest period. The third year, 2010, has seen pool returns fall away as the international market fell during 2011, leaving pool returns below harvest and early post-harvest prices. So in summary, deregulation has made basis levels more variable, has tended to push basis higher in the forward market, but are more extreme and often lower as well during harvest. The change in risk profile with deregulation is to increase the risk in the post-harvest market. Growers are able to move to use swaps to enhance their returns, to capture higher prices in the early post-harvest period, and to manage the risks of prices falling into mid-year. This is a new strategy. This is a strategy that did not work well in a regulated market because of the way post-harvest cash prices were structured under regulation. In the forward market, the risk facing growers has not changed. And as before, growers who want to manage the price risk from planting to harvest need to do it themselves via either swaps or multi-grade forward contracts. Improved basis levels are making multi-grade contracts more attractive than they have been under a regulated market, but basis risk in drought years remains very high. Thank you.